Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
And good evening, I'm Michael Hartzman. Today is Tuesday, May 18th, 2021. And as always, I'm on with my partner, Dominick Tavella. And good evening to you, Dom.
Good evening, Mike. How are you?
I'm all right. Beautiful day here on Long Island. So everything is good, thank God. No complaints. So you know what? The market last week was a little quiet. Last week felt to me like it was one of those weeks where the market was taking a little bit of a breather. And so far, the first 2 days of this week, the NASDAQ is starting to claw back a little bit. Last week, the market was down. This week, the NASDAQ starting to build back a little bit, had a sell-off earlier, late in the afternoon. But I don't know, Dom, it seems like we're in a little bit of a lull right now. The market's trying to figure out some direction.
I think that was spot on, Mike, figuring out direction. So S&P was down 1.35% last week.
Yeah.
And NASDAQ was down 2%, but I wouldn't call those numbers horrific.
No.
I think it's just trying to find its footing. We get conflicting data almost every single day. And the markets are starting to look at the data and saying, hey, what do we have to look forward here? So the inflation numbers came in a little bit hot, right? We talked about that last week, and that continued. Housing starts were kind of on a horrific part. They were not good at all. We've seen some other unemployment data, some other economic data points, but the markets is trying to really now figure out what is the next 3-6 months going to look like.
Yeah, and we talked about this morning with our broker call. You mentioned some data points, and some of these data points are interpreted contrarian, where bad news is good and good news is bad. So as you said, the jobless number was horrific, but what happened to the stock market that day? What happened to the NASDAQ?
Yeah, so let's spend a second on that, Mike, because I think that sometimes clients are a little bit confused. If the news is bad, is that good? If the news is good, it's bad. But if you think about this logically, I'll try to use that word, the unemployment numbers not being quite as jovial, and not as many people coming back into the work environment, housing starts not being as strong, that means the recovery, even though on pace, may not be at a flame out rate where the economy is growing so aggressively that it puts extraordinarily high pressure on inflation. So
Right.
Maybe the recovery is just going to take a little longer to take a foothold, and maybe not quite as bad inflationary data down the road, which is good.
Right. Which is good news. And then, you and I spent a lot of time on conference calls with really smart economists, and they're predicting GDP for the third quarter, or maybe even for this quarter, a 6 to 8% print, which would
China
be
rates.
Right, which would be phenomenal. But that's going to scare the hell out of the market.
So again, this is where the seesaw goes back and forth, and why we see days like today where the market was down, and days like yesterday where the market's up, because we all want to see the growth. We all want to see the economy recover. We all want to see people go back to work. But if we see really heavy inflationary pressures, that forces the Federal Reserve to raise interest rates quickly, and that puts a dagger in the heart of this recovery. So slow and steady makes more sense, but day to day, this is going to be a volatile game. And we've been talking about this for weeks, Mike. We've been warning clients for weeks.
I know. No, absolutely we have. And the other part of it is, clients ask me all the time, what are we worried about? And what we're worried about is inflation. And the other thing that we're worried about it because we know it's going to happen, is we're preparing clients for higher taxes. We're preparing clients for higher capital gain taxes, higher income taxes, probably lower estate tax thresholds. So these are things we're preparing our clients for, and that's why I'm thrilled. Tonight we have a friend of the show, a longtime friend of the show, Bennet Grutman, who's a CPA in Manhattan, who's going to shed some light on some of these topics.
So I don't want to give away the questions before we have Bennett join us, but that is a concern of mine. So I study the economic data, the leading economic indicators every day, week, month, and we make investment decisions based on that data. But the curveball could be a significant tax increase. And what would that do to corporate earnings? We saw what happened when we had the Trump tax cuts. What would a significant corporate tax increase do? And how about, how would that affect especially small business owners on the individual level? That could be significant and could have pretty significant effect on the markets overall.
Yeah, and as you pointed out a few weeks ago on capital gain rates, if they make capital gain rates, income tax rates, and a small business owner sells their business, that can be devastating as well. So as you said, we don't want to bury Bennett and take all his talking points away. So you and I will be right back with Bennet Grutman right after this break.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella. And joining us this evening is Bennet Grutman, one of the founding partners of a CPA firm in Manhattan, Davis and Grutman. Good evening, Bennet.
Good evening, Michael.
Good evening, Bennett.
Hi, Dom.
So Bennet, I don't even know where to begin. I mean, there's so many topics that are really important, and I'm just going to begin in no particular order with the one that probably affects everybody, and that's income taxes. So, someone's got to pay for all the stimulus. Someone has to pay for all the money that's been spent in the last year. So give us your take on the Biden tax hikes and what do you think he'll get and what do you think he will not get?
Okay, so the big provisions in the Biden proposals deal with an increase in tax rates for individuals whose income exceeds $400,000. Talking about an 8% increase in the marginal rates on income in excess of that. In addition, the other bite in the law is the proposal. It's not a law. Is basically doubling the tax effect of capital gains and potentially dividends, which currently live at rates of anywhere from 0 to 20%, with a 3.8% additional investment tax. That we're talking about them raising it, or they're proposing to raise those rates to 43.8% on the federal level. That's a pretty significant impact for individuals who are selling their home, selling their business, and obviously capital gains from their stock portfolios. It could become a very big drag on the capital formation in this country.
Okay.
Hey, Bennett, so I think you already touched on one of my hot buttons. They talk about how they're going after the wealthy and not paying their fair share of taxes. But when you look at the average millionaire in this country, everybody thinks of, Warren Gates and Elon Musk and Bezos, but the average millionaire in this country is not that, right? It's the small business owner who started a company 20, 30 years ago, or somebody who bought a 2-4 family house. It really is the millionaire next door. It's the average person on the street who's just done a good job managing their money and making good investments, and literally going after the little guy, not the big guy.
Obviously, when they talk about raising corporate rates or raising individual rates, they are talking about the small business owner. The major corporations, we all know, have hundreds and hundreds, if not thousands, of tax lawyers on their staff who are constantly maneuvering in a multinational situation in order to be able to mitigate the taxes they pay. But for the average Main Street operator of a small business, there's nowhere to hide. They will bear the brunt of these tax increases.
So Bennett, speaking of nowhere to hide, there are very few deductions that we have left. For instance, an average married couple right now, if they sell their house to get the $500,000 exemption, is one of the few that exemptions they still have. Are any of these new proposals willing to strip away any of the few exemptions that we have left?
Okay, so one of the proposals on the table actually is another detrimental hit to your deductions. Your SALT deductions, that's the state and local income taxes and real estate taxes, your mortgage interest, your contributions. They're talking about reinstating, if anybody remembers the old Pease laws, but they're talking about reinstating a cap on the maximum amount of itemized deductions you can claim in a given year at 28%. So while they talk about removing the SALT limitations and potentially removing the mortgage interest limitation, which right now under the Trump Act is $750 and would go back to $1 million under the sunset provisions, which I'd like to speak about to speak to for a second, but they would cap the deduction. So by giving them back and then telling you capping it is not giving, it's like giving you ice in the winter. So you're not getting more deductions for these middle income earners, these earners that are earning $400,000 or $500,000, your middle America shop owners.
And Bennett, to a point you made earlier, when you're going after these small business owners, they're responsible for creating the majority of jobs in this country. We all think again about Bezos and Amazon, but the small business owner creates the most amount of wealth. And they're the most entrepreneurial people in this country. When you take this capital out of their hands, what happens then?
Well, economically, if they're the ones that are pushing the capital into the economy, it disappears, right? It's going into the government coffers. It's not going back into Main Street economies.
Or jobs.
Or jobs, yes.
So Bennett, I know you're not a political analyst, but you've lived through various tax hikes and various tax cuts throughout your career. Nothing's probably going to happen in 2021. It appears now that this administration is focused on the economy reopening and getting things back to normal. So does that leave the Biden administration basically a 6-month window in the first half of 2022 to get this done before people start talking about the midterm elections?
Well, what I've read is that everything they're talking about, they want an effective date of 1/1/22. So even if we don't get any passage till early in 2022, it appears that it will have an effective date of 1/1. So whatever planning and thoughts that need to be done, particularly in the wealth transfer area, the window is right now. The window is going to close on December 31st.
Okay.
And in my experience, we will more likely than not get a change in the tax law for no other reason than the fact that they want to eradicate the Trump tax cuts. The Trump tax cuts by themselves eradicate themselves at the beginning of the 2026 tax year. All of the provisions in the Trump tax law sunset. And so they can skip over things, and those provisions will expire. They will take a natural death. So it's an interesting political scenario for, and we have in politics, we have people on all sides, all the way to the right, all the way to the left. So it's tough. It's tough for them to get a lot of traction and a lot of headway. There's a lot of difference of opinion over these proposals.
Ben, just spend a second on the limits now for estate taxes. How much can you pass on to your heirs, and what are they proposing?
Okay, so the current exemption is 11.7 million
Per person
with what's called the DSUE, which is if a spouse dies and has not used their entire exemption, that portion of the exemption they have not used carries over. So a married couple can effectively leave $23.4 million to their family. And they're talking about 3.5 million as being the exemption. I've read nothing about the discussion about whether there'd be a carryover, whether the unused portion could be used by the surviving spouse. But that number, not only is that number a significant drop, but there's also a significant increase in the rate of the tax. For estates less than 10 million, the rate would go from 40 to 45. For estates less from 10 to 50 would be 50%. Anything in excess of $1 billion would be a 65% tax rate. And so they're going hard. This is all part of Bernie Sanders' approach to going hard at the extraordinarily wealthy on the estate tax side, which from a political point of view is favorable to the majority of Americans who it doesn't impact. But it is a pretty drastic drop, to answer your question.
But to your point, I mean, in terms of chopping away the deficit, it really is a drop in the bucket to go after these people, but it acts more as a disincentive for the small business owner to try to build their wealth and create these legacies for their family.
Yes, not only that, within these provisions, within these proposals, they're talking about the elimination of the step up in basis. They're talking about severe restrictions on valuation discounts so that the transfers would take place at fair value without a discount, which would increase not only the tax, but the amount of wealth transfer. So they have restrictions on the use of GRATs and GST trusts. And also they want to close down the intentionally defective grantor trust, which is probably the most popular estate tax transfer of wealth technique in use today. So these are very aggressive, very aggressive.
Myself, Michael, and I'm sure you see it in your tax practice, we're not talking about these billionaires, right? These are very normal, everyday people who started a business maybe 1, 2, 3 decades ago, never took $1 million a year out of the business in their life, but now they're prepared to retire. They want to sell off that business. They want to sell off that apartment building or that a piece of real estate that they own. And now all of a sudden they pop into that $1 million 1 year income bracket in a heartbeat.
That's right. That's right. And that's a dramatic effect on their entire financial life plan and retirement plan, right?
Yeah, the ability to retire and how comfortable they can retire.
Yep.
So Bennet, how much of this, in your opinion, is a negotiating starting point where they know that even the more moderate Democrats are never going to vote for a lot of these things?
I don't know. I mean, in truth, these things tend to take on a life of their own at some point. There's so much compromise that goes on. The state tax area is an area that has less resistance than the income tax area because it represents a much smaller portion of the U.S. voting population. And again, if they do nothing, we go back to the 2017 tax laws in just a few years. So whatever they want to gloss over, whatever they can't reach on compromise, they get it in the end game anyway. So it's a really interesting thing because we are guaranteed a tax law change in 2026. So how hard they go and which direction they go, it's all very, very iffy.
But you would suggest, Bennet, that this year we're safe, or that's just wishful thinking?
This year, I am encouraging, I had meetings this morning, meetings yesterday, encouraging my clients to take advantage of the IDGTs, make these transfers, get this stuff out of your estate. Again, this discussion in some of the literature about the fact that some of these things won't be grandfathered. The interesting one that affects your planning as financial planners is the ILIT. They're talking about a provision where the only thing that would escape tax in the ILIT is those amounts that have been reflected on gift tax returns. So obviously, the premium is paid each year. The grantor puts the money into the ILIT. The ILIT pays the premium. File a gift tax return. You use your annual exclusion for donees. So if you have 3 children, you have a policy. You have a $45,000 exemption. your wife consents, you got a $90,000 exemption, you file your gift tax return, you pay no gift, policy pays off a couple of $1,000,000. Well, now they're talking that anything in excess of what was reported on the gift tax return will be brought back into the estate.
So
No grandfathering.
so all the rules they gave us to play by,
Right.
we played by them diligently. Those rules now get literally changed in the middle of the game.
Which is an extraordinarily unusual congressional act. You know, from a professional point of view, you can always rely upon the laws in existence, and you could be somewhat comfortable that if you took care of a transaction prior to the effective date of a change in the law, that you would get grandfathered. They actually in the literature talk about, not grandfathering this. And that's, I'm sure, very significant for you guys. Michael done a lot of these, and I've done some with you, so you can understand the effect.
So just for the benefit of our audience, an ILIT is an irrevocable life insurance trust, is what Bennet was referring to, which is a very, very useful estate planning tool. But Bennet, to your point about the ILIT, the insurance lobby is one of the strongest lobbies in the country. So again, you may not know the answer to this, but I'm going to ask anyway. Where is the insurance industry on this in terms of allowing this to go through or trying to prevent it?
I'm sure they're going to try and prevent it. They have to try. But again, I don't know what the outcome might be.
Would you say what the appetite would be? Is that what you said?
What the outcome?
Oh, the outcome.
Something like this. I mean, they've thrown it out there, right? So anything's possible. So
But to
Wild Wild West right now.
To your point, not to your point, not grandfathering these things, you would think would lead towards various class action suits of all the people who've done this planning over years, paid for policies for probably decades, and now they get unwound with the stroke of a pen.
That's the way it works. I'm not saying it's, I enforce the rules when I do my work. I don't make the rules.
Right.
But you are correct that these are really serious things that they are talking about that I don't even know if they understand the ramifications.
Possibility they don't.
And it's very possible that they don't understand the economic ramifications of allowing generational wealth to transfer.
Listen, Bennett, I don't looking to make a political call here, but when you hear Elizabeth Warren talking about how it's only going to affect the 0.004% of the population, and it's really meant to go after these ultra wealthy, this is the furthest thing from the truth, right? I mean, this is going to affect the everyday, average, hardworking small business owner in the country. I don't think I'm exaggerating when I say that.
Yes, it's going to open up a whole new area of planning, and talking about what kind of sense does a retirement plan make now? If it's going to get taxed like this at death, does it make sense? The accumulation of wealth and the transfer of wealth has built this country from generation to generation, and there's a lot of study in a lot of countries whose wealth transfers free and clear of taxes, where that spurs the economy further. Once you take the money out of the hands of the individual, of the property owner, of the shop owner, you know that it's detrimental to the economic being of the area.
And the other thing you mentioned quickly, which we didn't touch on, which is also a potential disaster, is the elimination of the step up in basis. So we're running out of time, but could you just touch on that for our audience? What that means, Bennet?
Okay, so when an individual dies and a property passes through the estate, it gets a new basis. There's a theory that the tax is being paid, but the exemption may be applied. So when the next generation receives that property, they sell it with a new basis. To impose a tax on the fair market value of a property without granting a step up, and means that it's basically it's like triple tax. Because the original owner paid tax on the money before they acquired the property. Now they're going to pay an estate tax on the fair value of the property, and then they're going to pay an income tax when they sell the property with a low basis. So it's like triple taxation on an asset. That really is removing wealth out of the country.
Right.
Then it's stressing again that step up in basis or the loss of it is not just to billionaires, right? They're not saying, oh, you have to have a net worth of 100 billion in order for you to lose that. That's everybody out there.
Yes,
That's everybody's home. That's their home.
Right.
The value of everything they've accumulated over an entire lifetime.
Maybe that one valuable painting that they invested in early on.
Right.
Hopefully they have a small basket of assets, and they're just leaving the family. Have to be sold to pay the estate tax, and then they have to borrow money to pay the income tax.
So Bennett, we have a minute left. This has been a pretty depressing conversation. No fault of your own. Is there anything good in any of this tax package?
If there is, I have not found it yet. I'll keep looking for you.
So Bennett, as soon as you find it, will you let us know? We'll have to bring you back.
But Bennett, I know, and Mike was right about it being a depressing conversation, but it was an honest conversation, right?
And it's
It
an
was
important
telling
conversation.
people the truth about not PR and not politics. This is something that literally will affect every American that has accumulated any reasonable amount of wealth over their entire lifetime.
I agree.
Bennett, thank you for joining us tonight. Stay safe and stay healthy, my friend.
Appreciate the honest conversation, Bennett.
Great. Thanks, guys. Bye-bye.
We'll be right back.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. Now, back to the Lebenthal Report.
And welcome back to the Lebenthal Report. I'm Jordan Kimmel, Portfolio Manager, Chief Equity Strategist. And it's an absolute pleasure to bring on both a friend, a colleague, someone I know for many years. It's Ed Matluck, the president of Hedgemetrics. And Ed, thanks so much for joining us.
Thanks. Good to be with you.
Ed actually wrote a piece in this book, The Magnet Method of Investing. Ed's done back testing and really knows both the magnet and fact strategies literally as well as anybody, and currently serves as our portfolio risk manager on all four strategies. So Ed, I think the right thing to do to get things started is share really what Hedgemetrics is. You're a PhD in economics, but this is more of a factor analysis on individual companies and sectors. So share, the kind of research Hedgemetrics sells, and maybe even you could share how you help me directly.
Okay. Well, what we do at Hedgemetrics is that we analyze market factors, and I'll tell you what that is in a minute. But we look to see which factors are overbought and which factors are oversold, and try to keep our clients out of the ones that are too overbought and get into the ones that are oversold, because they tend to mean revert. And we look at all of these things in terms of standard deviation, not level. Standard deviations and relatives rather than levels, and which is what most people are used to. So factors are just things that groups that stocks can fall into that are just not obvious until you start thinking about them. I mean, the ones that everyone knows is value versus growth, and maybe momentum versus flat line. And we look at other things like transitions and different kinds of value. We look at high debt versus low debt. We look at yield versus non-yield, things like that, which aren't obvious. And we also use different kinds of measures. For example, a measure that we look at for valuation, other than price to book and say enterprise value to EBITDA, would be something like percent off the stock's high, 2-year high. Stocks that are way off their 2-year high tend to be oversold and are very often value stocks that are going to mean revert. So we look at all those things, and we also look at earnings estimate momentum is very important, and we group stocks by stocks that have beaten earnings estimates and not beaten earnings estimates, and look at what's happened to the price of those. And for example, in the most recent quarter, stocks that beat earnings estimates did not outperform the way they normally do.
Right.
You know, why that is another issue. But
well, Ed, let me kind of couch that this way, okay? So you know that Magnet says we look at all these fundamental things that you talk about. We've got all these criteria, and what we say is we could actually say which companies are better than others, right? But what you're doing, which is I think fascinating, which is why our relationship is so long and valuable, is that sectors themselves get carried into a different place, high and low, out of favor and in favor. And what happens is amateurs buy into the frenzy, and professionals sell that frenzy. And so I want you to describe this issue, because we know the trend is your friend until the end. Your methodology has this ability to find what's at the extremes, overbought and oversold, for opportunity to shift.
right, well, you know, just as everybody knows, stocks generally don't move in a straight line. They go up and down, and often up and down within a trend, which could be also up and down. And the issue is what's making them, when are they at the top of the trend line, and when are they at the bottom of the trend line? And sometimes it's obvious that earnings were good and then all of a sudden they're not good. But other things happen where that are really influenced by the overall market and psychology that's going on that is not obvious just from looking at the stock or looking at its fundamentals. So what we try to do is group stocks based on those other things that are not necessarily observable directly, but when you look at the groups of stocks and see how they're moving, it becomes more obvious what they are. And then we tell our clients that XYZ stock is at the top of the channel because people are buying momentum, and this is a momentum stock, and that can mean revert, and the stock is going to start going down to the bottom of its channel, and it's not going to have anything to do with earnings or things that the fundamentals that you're looking at.
Right. So Ed, let me just share something, because as we do this discussion, we know each other for 20 years. There's a metaphor going on in my mind where you're my best kept secret. You're in the dark, and people think that I'm smart. Okay. But you're in the dark here, actually looking at data. And the point I'm making here is people who don't have the seasoning that you do. And I want to mention, you could share how, but I know you've had interactions, or you were in the same time frame as Mario Draghi, and I think you were in school together, or you could share that. But the point is, you've seen cycle after cycle after cycle, and that's critical to me. And so we're used to an economy that this sector works and then that sector works, but this is a different time right now. We have the pandemic, post-pandemic. Every move is exaggerated, if you will. So nobody really would have guessed housing would have done really, well a year ago. Our factors, as you know, picked it up. You could describe for the crowd how now everyone started to beat the drum. You came to me and said, time to reduce some housing, and kind of share that kind of turn that takes place.
Well, housing, is traditionally you buy housing when interest rates are low because people can afford mortgages and builders can borrow, and that's when housing stocks go up. But because of the pandemic, everything got distorted, and there was a huge increase in demand that was unexpected as people started leaving the cities or moving to places where the pandemic seemed like less of a problem. So housing went through the roof, and interest rates stayed low, but housing prices got so expensive that people couldn't afford to buy the houses they wanted. And so after an initial shoot up in the housing prices, the housing market has plateaued and is coming down a little now. And it's really as a result of inflation and in both housing prices and in the things that are used to build houses like lumber and wages of construction workers, absence of construction workers from COVID, and all these things that normally don't happen.
Right. So the point is maybe things are happening faster, maybe they're happening to different extremes. As an economist, you understand this gigantic demographic, which is not short term, which is multi-year in the housing market. What you basically said is, again, because we're managing these portfolios professionally, it's not a matter of everyone on this side of the boat and everyone on that side of the boat. What we recommended, what we did is we cut the positions back, knowing that they were overpriced. So let me jump to another sector right now, which is just capturing everyone's attention. We hear about lumber, we hear about materials, but we also saw the greatest kind of overperformance of growth versus a value and cyclical. There's a change of regimen. Is it a week? Is it a year? Is it bigger than that? And I want you to kind of share what you're seeing there.
Well, everybody knows how growth outperformed value for the last couple of years. And pretty much it did that more than it's ever done before. And in fact, tech growth was seven standard deviations.
Say it again. Seven standard deviations
overboard. And it was obvious that it was going to come down. And within tech, software was 2 standard deviations above that. People had just been buying this stuff willy-nilly, and things like price to sales and normal valuations were, off the page. So we told our clients, short these things. I mean, in this case, it was just a short. And finally, tech started to break. I think that the sort of the catalyst was inflation, because growth is highly negatively correlated with inflation. And
right. So Ed, let me stop you here for a second. What I love the most is that you looking over my shoulder with our team and keeping us out of the high risk. What I want to do now, before I run out of time, I want to ask the engineer to bring on Dom and Mike, who really are kind of in the middle of this whole discussion that we always share with clients, what to expect, where we may see some outperformance. So if we could ask Andrew, our champion engineer, to bring on Dom and Mike, I'd love them to jump in and see if they have anything for Ed. And Ed, I think that, here's Dom and here's Mike, and let them take whatever order they want. But I think that there's a super shift going on, and let them handle it from here. I want to see where we go.
Sure.
Thanks, Jordan. Ed, thank you for joining us tonight.
No problem.
So I asked Jordan a question this morning because Jordan, to me, is phenomenal at parsing through this information. And just one thing that captured my interest this morning was how much time you guys spend when a stock starts to get shorted, and how much weight do you give to a stock that has a lot of short interest. And is there even a way to measure that interest?
Well, I'll tell you, because obviously that came up this year. We have a factor called short interest. And we look at how the stocks that have high short interest are performing relative to the market and to the stocks that don't have high short interest. And the ones that had high short interest starting about 6 months ago, were way oversold. And they looked like a buy. And we started suggesting that people look at those stocks and buy them. Now we don't recommend specific stocks. We just
Right.
recommend groups. So, but the clients know what stocks are in what groups, and they decide for themselves what to do with them.
So just for the benefit of our audience, when someone shorts a stock, they believe the price is going to go down. So when you see that getting a little frothy, you think eventually that worm is going to turn, is what you're saying, and the stocks start to go up.
Right.
Thank you. See you go, Jordan.
So let me just, before Dom goes, I was saying that's very hard information to find. And Ed, I didn't even know you have it because we focus on quality stocks, not the most shorted. We're playing a more conservative approach here, not high speed trading. But Mike, there's your information. Hedgemetrics has it. So let's turn it over to Dom to see what he's thinking.
Yeah, we just so you know, we just put it in a couple of months ago, so that's why.
Okay.
Thank you,
Smart
Ed.
move, Ed. Good move.
Hey, Ed, so we know, I'll do this quickly. We know that growth has way outperformed value, especially over the last decade, and especially technology. So just about every new account, new client coming on board, they're way overloaded in this stuff, right? Either because they've owned it for a really long time, or perhaps they've performed extraordinarily well last year. And there's this idea of rotating now into a more value play. But is this a short-term phenomena, or do you think value outperforms growth for an exceedingly long time?
I think it's not a short-term phenomena because of inflation, because there's a huge negative correlation between growth and inflation. And the Fed keeps telling us about transitory inflation, but I never read a book that had a chapter on transitory inflation. I don't think there's such a thing. The only way you get rid of inflation is to kill the economy. And the Fed isn't going to do that anytime soon. So as we're going to have sustained inflation, at least for a couple of years, and that's going to put pressure on growth and tech. Now, there are some tech that aren't as overvalued as other tech, and some of that will, do all right. But I don't think you're going to see the kind of anything close to the kind of outperformance that we saw in the last couple of years for a long time.
Right, Ed. So you're a mean reversion guy. I have a feeling that you're more than correct here. By the way, your PhD is in economics, and there's also no chapter on negative interest rates.
That's correct.
In those economic books either. So our 1% rates right here in the United States are supposedly exceedingly generous on the world stage. It's uncharted time. That's why we want to manage risk all the time and stay away from the fraud. So Ed, thanks for joining us. The secret's out of the bottle. We've shown Ed and Hedgemetrics. Thanks for joining us. And Ed, we'll talk as we always do often. We'll see you soon.
Very good.
I'd love to have you back as this thing unravels to get your opinions going forward.
Sure, no problem.
Thank you, Ed.
Delighted.
All righty. We're ready for a quick break. We'll be back with more Lebenthal Report following a quick break.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella. So Dom, listening to Ed and Jordan, it always becomes so evident that it's important to know not only you have money invested in the stock market, but where in the stock market do you have investments? A year ago, we overweighted healthcare and technology. We still have a decent weighting in those sectors, but we've added to energy, we've added to financial services, we've tiptoed a little bit into real estate, not much. So yes, it's important that a client knows they have 30, 40, 50% in the stock market, but the way you add alpha, the way you outperform is what sectors do you pick? And that's why, thank goodness there's guys like Ed out there who, able to break down and provide this information in the way that they do.
Yeah, Mike, I brought it up to Ed, and you and I see it almost every day. A client comes on board and they're coming from other firms, and it's not hard to understand. They have in their portfolio what worked well yesterday, right? So they own the FANG stocks, the tech stocks, the growth mutual funds, the growth ETFs, and those were all terrific investments the last 12 months. But the question is not what did you do for me yesterday? It's what are you going to do for me tomorrow? And I think Ed made an extraordinarily valid point that, and maybe it's inflation, maybe it's higher interest rates, but it's highly unlikely what worked really well yesterday is also going to work really well tomorrow.
Right. And sometimes it's an easy call, right? A year ago, we all went about a month or two without buying gas. So it was an easy call to underweight energy because, no one was going, and literally no one was going anywhere, right? The roads.
We can talk about airlines, and we can talk about cruise ships, restaurant chains.
Right. But now as things start to slowly, creep back to life, doesn't make sense to buy energy. You would think it makes sense to buy energy, but if we have all this inflation, which really is a drag on the economy, will energy be as strong as people expect? So that's kind of the nuance when we create these allocations and we create these sectors.
Definitely the sectors. You mentioned healthcare. We still love healthcare. I think just the whole aging of the population and people living longer. But we're going through a cosmic shift now where a certain types of investment work really well. And you have people out there convinced it's going to go on forever. I don't know that the next decade is going to look like the last one. I always describe it to clients as the weather's changing and we have to change the outfit we're wearing. We made a very deliberate rebalance in our portfolios. You mentioned some. Dividend players is a big favorite of ours. We'll see if it works out, but people like Ed always give us a lot of guidance and a lot of insight to what this picture looks like.
Oh yeah, and you talk about 5 or 10 years ago, people have short-term memories from the point of view, now people, if you mention a company like Peloton or a company like Zoom or the technology cloud computing, you feel like it's been around forever. But it hasn't been. It wasn't even, these companies weren't even around 10 years ago. The technology didn't even exist. And now it's ubiquitous, right? So yeah, the sands are always changing and we always have to readjust those portfolios to adjust for those changes.
Yeah. So, you and I have been in the industry for over 30 years and it's not, I still scarred for life, 2000 prior, 1997, 98, 99, with the tech boom and then the tech wreck. And then the following decade was the value decade where tech didn't really do well at all. And then 10 years after that, it did. So these trends can be very long, and holding on to some of these positions because you think they're all going to come back, you think they're going to go back to their glory days, could be a really failing strategy.
Well, to that, Dominic, I'll give you a blast from the past 10 or 15 years ago. How about the BRICS? Brazil, Russia, India, and China. Remember that?
That's all you need to own, right, Mike? It's all you need to own.
It's all you need to own because they're going to rule the world. Money was flowing into that sector like there was no tomorrow.
And if you owned them today, you literally would have gotten wrecked. You would have got hit in the head with a brick.
Nicely done.
So the reality, it's what our clients have us for, Mike, is to make these adjustments and tweak it. And not that we have a crystal ball that works, but we do have a lot of very bright people that I consider our support staff, right? Our research costs us a lot of money, but it's well worth it. And they provide us insights and hints that then we decipher and put into place in client portfolios.
Again, we're grateful for all of them. And on that note, Dominic, I will see you next week, my friend, because our time is up tonight.
Looking forward to it. You have a great evening, Mike.
Good night, everybody.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.